Hi, everyone. Welcome to the latest webinar series sponsored by the Center for Real Estate and Finance at Cornell University and eCornell. I'm really happy to bring together the group of speakers we have today to discuss the view for 2022, some insights and expectations for the U.S. hotel industry. For today, we have as our speakers Mr. Patrick Scholes, Managing Director at Truist Securities, Jan Freitag, who's a Director at CoStar Group, Michael Medzigian, he is the Chairman and CEO of Watermark Lodging Trust, Inc., and Michelle Russo, who is the founder and CEO of Hotel Asset Value Enhancement. So our run of show for today is for me to ask our participants to spend a little time with us talking about the world from their point of view right now. It's obviously a very interesting time. We expect to have a great discussion. Those of you in the audience should know that if you have a question, please post it on the chat, and we'll try to get to what we can toward the end of the session. So let's start out with Jan. He's going to talk a little bit about how the data looks for our recovery by quarter and by chain and region and scale. So go ahead, Jan.
Thanks, Professor. Good to be with you virtually. I guess we can't be at Cornell right now, so might as well be home. Thanks for having us and setting this up. So the recovery is ongoing. Used to be the standard statement, but then Friday after Thanksgiving, we all learned a new Greek letter. And now we're sort of wondering, well, what does Omicron really mean? So I'm sure we will talk about it. We talked about it in the pre-show. So just to look at what the data has shown us so far, if you look at the first quarter, RevPAR this year was down 42% from 2019. The third quarter RevPAR was down only 5%. It's really a tale of two cities, and my colleagues here will talk about this a little bit more. If you are in a resort destination, if you are very high-end, you are just rocking and rolling. You know, it's super interesting to see the data year-to-date. Luxury occupancy is 52%, implying really that half the rooms are empty. But room rates are up 12% over 2019, which was the best year ever. So maybe we've learned yield management. When we look at resorts versus urban hotels occupancy, you know, is 51%. Rates are down 18% or so year to date from 2019. For resort properties, very different story. Occupancy almost 60%. Room rates are up 13%. So the point of all this is just to say the American leisure traveler doesn't seem to care what the case count is, and they're just going. And they're spending money, and they're spending their vacation days that they accumulated in 2020 and 2021, and they're spending the money that they've saved. If you're a downtown location, super tanker hotel, 800 rooms, lots of ballroom space, you're still in a world of pain, you know, in San Francisco, in Washington, and in Houston, just because there are not a whole lot of large groups out there. And the question is, does return to office, as that gets pushed back out, what does that mean for individual business travelers going to a major destination? Because if Patrick's working from home, you know, and I want to visit him, I can't visit him, right? We're not going to meet in his bedroom. So we might as well just do this all on Zoom. So that's like a big question mark for 2022. So that's sort of what we're seeing high level.
Excellent. Thanks, Jan. Michelle, do you want to give us a little insight into both the operational environment that's going on right now and maybe from asset management side?
Sure. So we are very positive about the recovery next year and acknowledge that there's going to be pauses, as we call them, as we're experiencing now. And those who are traveling pre-pause, small and medium corporate, leisure, will continue at their pace. But you're right, Jan, we have to wait for big corporate to come back, not just for the overall corporate recovery, but also in a big part for the group recovery. even for the associations, because a lot of association attendees go to hear big corporate names on the podium. So that is important for to achieve the projections that, you know, the prognosticators are forecasting for next year. I think we're a little bit more conservative, even though we're highly positive on the outlook. We're Pricewaterhouse and Smith Travel are forecasting to be in the mid-90s in terms of penetration to 19 levels. We're in the high 80s. And there's been great news about the continuation of leisure and what have you, and all the things Jan said, but I will tell you, the labor situation continues to get tougher and tougher. It's not just about wage rates. It's just a real battle, and so that is a continued challenge. We also have massive food inflation. The brands are starting to reinstate a lot of their standards that we're just not quite ready to receive, not just from a cost standpoint, but a lot from a labor standpoint. And we have to continue our modified approaches in order to be able to just service the personnel. And the question, especially at the high-end leisure side for 2022, is, you know, the customer tolerated paying high prices and didn't mind it for this year, but the feedback we got is that they expect the services back if they're going to keep paying for those rates on an ongoing basis. So that's our outlook.
Thanks, Michelle. Mike, you own a whole bunch of assets in a bunch of different places. I know you've been active in the market, so maybe you could give us a little bit of a sense from the standpoint of an owner.
Sure. Thank you, Steve. I'll start by saying I agree with everything I've heard so far. We're looking forward, not back, but I do, Jan made a comment. I can't remember, Jan, if you said tale of two cities or haves and have nots, but it's interesting how profound that is in the industry right now. And I want to look back for 1 second just to give a frame of reference. So there's no precedent for what's going on, obviously. Our portfolio is made up of all urban and resort hotels, generally bigger boxes, higher end boxes. We went from, in February 2020, we went from 76% occupancy in April to 4%. Had to close over 50% of our hotels, furlough 10,000 people, almost killed me. It was like a train that was coming that you couldn't stop. I think we probably lost $50 million of cash in the first month. Took unimaginable effort to get to where we are now. And obviously the world is dramatically better. We're very constructive on where things are going. I imagine we'll talk more about that as the session goes on. But in January this year, our occupancy was about 20%. We're up to about 65% now. So things are obviously dramatically better. Still a long way to go. We're still down 15% from pre-COVID levels. Resorts, as has been said, are terrifically strong. Rates much, much higher than they were in 2019. And the cities are improving quite a bit. Weekdays improving quite a bit. We're all concerned about this new variant and what that's going to mean. I think in 2022, the resorts are positioned for more success. In addition to the leisure demand that's made us so successful, we're layering on a lot of group business, surprisingly more than I would have expected at this point in time. I mentioned on our earlier, one of our resorts in Florida in last month, 75% of the demand was group. So I was frankly kind of stunned by that. I just didn't realize there was that much group out there. It's still smaller group, social, but business groups are coming back. So with that group base in 22, I think we're going to do much, much better. Urban was getting a lot of traction during the summer, thanks to leisure. We've been monitoring, I'm sure everyone on this call has been monitoring BT, business transient, very, very closely. And we weren't seeing a lot of change over time. That, in my mind, has really changed. Our BT room night production is up over 100% from where it was in June of this year. We're still 50% below where we were in 2019, so a long way to go, but a lot of progress over the last few months. We have not seen a lot of impact from the new variant. I'm very concerned about it. I'm wondering when we're going to start seeing it. We saw the JP Morgan Healthcare Conference cancel or go virtual in San Francisco. That's a big loss. We've had a few groups cancel or push out here and there, but not a lot of change from the new precedent. So I'm pretty confident about how we're positioned going into 22. I think some of the analysts were behind and they're catching up. I think they're generally in agreement. We're forecasting our RevPAR in 22 to be pretty close to 2019. Just to put in context, I mentioned something about rate earlier. Industry, Jan, I think year to date is down about 6.5% in rate as compared with 2019. Our portfolio's down about 2.1%. So you can see the power of the resorts. And I think that's going to help carry us quite a bit in 2022.
Great.
And I'm sorry, I'll say one thing. I don't know that we need to get into it here, but I'm with Michelle. There are a lot of challenges that we're dealing with. I'll wait and see if you want to talk about some of those things. Maybe more of them piling on than I've ever seen in my career. We all talk about supply chain and labor and things that are top of mind. Lately, hacking and ransomware, and we've all known it was out there for a while, but all the bad behavior seems to be exploding around us, and that's fairly concerning. That's not an industry issue. That's every industry.
Thanks, Mike. Since you mentioned analysts, Patrick could probably give us a little bit of an insight from the standpoint of how the larger public companies are handling all this, and what kind of information he has regarding their performance.
Yeah, absolutely, and thank you. Good morning, everyone. What's interesting is, we hear that there so far has not been a tremendous amount, really, if any, pullback as we've seen in the Smith Travel weekly data. But as we've seen in the last several weeks, the equity investors are not waiting to see it, or not waiting to sell the stocks. And what's really interesting is if we go back pre-Thanksgiving, many of the public companies, such as the C Corp, such as Hilton, Marriott, were trading on full earnings recovery by the end of next year or early in 23 at valuation multiples that were pretty much at peak. So it was expecting a pretty straightforward, strong recovery. And then what happens is you get some bad news and some concerns, and investors are, they're quick to pull the trigger here. What's interesting, going back into some of the forward booking data that we look at all of the time, that for the most part, really very minimal impact on bookings. There have been a couple areas that we have seen so far, seen some cancellations for international. We've seen that in the Caribbean. Additionally, what I think concerns us and equity investors, we're hearing, and anybody can Google this, is a delay in the return to office. And that's important because go back a couple months, everybody thought, hey, you know what? The first half of next year is really going to start to see some normalcy. And you just had some pretty bullish comments from executives at some of the public companies about, a surge in corporate bookings. And I think just the fear is it's just going to, it's going to push the recovery back a couple months here. And when you have stocks sort of trading at peak levels on peak multiples, well, all it takes is a little bit of concern, and those multiples get contracted a bit, and we see the stocks fall. What's interesting, though, on the other side, another part of the growth story for many of the brands is the continuation of their strong unit growth or their pipelines. We saw some pullback from pre-19, but those pipeline growths, Hilton, Hyatt, Marriott, continue to be exceptionally strong. And that's just compounded growth year over year. So I would say that continues to be a bright spot, and that's somewhere where investors continue to look favorably on many of the C corps, and it's one of the reasons why those stocks have, prior to Thanksgiving, have been driven to all-time highs. But I think at the end of the day, investors right now are not waiting for executives, CEOs of public companies to say, hey, we've seen some pullback. I think people are just being a little bit more cautious on the stock side at the moment.
Hey, Patrick, if I could interrupt, I just to echo, so we are involved in more new development projects than we were in 19 as a company, which I think is fascinating to me. And we're not talking select service, we're talking big, chunky assets. But I wanted to get your opinion on, the second versus third quarter earnings calls regarding group, because in the second quarter, there was a lot of positivity and everyone was happy to communicate that the pace was at 85% of 19 levels. And then you read the earnings transcripts from the third quarter and it was very vague. And we know in our portfolio, we experienced, really not a lot of growth, some attrition. And we also know that the groups are just waiting to sign because they're so afraid now that as an industry, we are doing the right thing and trying to collect attrition, which we appreciate as owners. But the companies are just sitting on their contracts. So that has really affected the pace for 2022, which again speaks to this pause concept. And I'm wondering, we think it's just pent up and it's going to convert or happen, but I wanted to get your thoughts.
Yeah, and I think really the big difference between the public company earnings would have been in late July versus late October was Delta variant hitting basically early August. And I'll give you a real world example here. Historically, we hold a investor conference in Boston in early December every year. And as of August 1st, we were fully intending to go live. It came down from the higher ups that about 2 weeks later said, no, once Delta hit, you're going virtual. And I'm sure we were not alone. So I think that's what's happened. What the other thing very similar is, we still have deposits that we've promised we're going to use next year. So but we haven't confirmed next year. And so that's kind of where we are. It's kind of getting a little, just getting pushed back. And that's, I'm sure our scenario can be multiplied by hundreds, if not thousands, of what's going on in the industry. We really were looking forward to doing it live, and everybody wanted to, but it came down from above the corporate decision makers for that it was not going to be live this year.
And just add to that.
Sorry, go ahead, Jim.
Yeah. If I can just add to that some numbers. So in November, we sold, almost 4.5 million group rooms in the United States. That's not bad. It's still a third below what it was in November of 2019. But, there are 4.5 million group rooms that were actively going on. So, Michelle, we don't have that forward looking. So it's going to be super interesting. Is this going to contract, or is this going to just be pushed and pushed and pushed with like what Patrick just said, it's not materializing this year. Is it going to happen next year is the big question mark. But group is happening. Totally agree.
Yeah, for what it's worth, this just one portfolio. When we had our third quarter board meeting in, I can't remember, late September, early October, we were down, for 22, we were down 18% to 19. We just had our board meeting a week ago and we were down 13%. So we're chipping away, we're still down, but good progress, I would say, over the last quarter.
Well, all of you are already moving into the space of talking about the challenges that are coming up for for the 2022 year for our industry. Obviously, we have already been talking about the business group demand. The business transient is related to return to work, and obviously that depends on where you are and the size of the companies that are involved and how it impacts, hotel demand from that angle. The supply chain issues, which are not going away anytime soon. And I think another big issue in the industry, which is not just in our industry, in all industries, is inflation. Hotels have been historically seen as kind of like an easier inflation hedge because our rates are set, on a regular daily basis. But even in that environment, you have some real inflationary pressures, as well as how it impacts, people in the ownership space if they have floating rate debt. So it's not only how much can we pass through on rates from the inflation, how it compresses the profit margin, and what it does to, financing. So I'm open to continuing the discussion about the business demand side of things, if you guys want to weigh in on that some more, or any of the other issues.
Hey, Steve, if you don't mind, I'd like to pick one of those and maybe kick it off, because inflation, when we all saw inflation coming, I was really wondering whether, hotels have been the best inflation hedge over time of any real estate property type, right? And when we saw inflation coming, I was wondering if it was going to be the same this time, because there are so many, the consumer has just gotten so much more intelligent about how to book. There's so many different channels that they can book. We didn't have a lot of pricing power before COVID hit. If you look back in 2018 and 19, things had really flattened out quite a bit. Right now, it feels like I'll be curious to see what Jan thinks about this. It feels like we're getting this great pricing power, but it's in the resorts. Our cities have some massive problems, and I've got hotels in many of these places: San Francisco, Chicago, New York, Portland, Minneapolis. The list kind of goes and goes of where we've got issues that really need to be solved, and there's not a lot of demand in those markets yet. It's getting better. Chicago's been surprising people on the upside, but we are not getting that kind of pricing power in places where we're running 40 and 50% occupancy. And there's a lot of cities like that. And that's not going to get resolved overnight. So I don't know if we're seeing inflationary increases in our pricing, or if we're seeing it just because there are certain markets where there's so much excess demand. Jan, I don't know if you've got a view on that.
Yeah, quick comments. So the room rates in November, year over year, up 41%. So everybody's wondering, saying, "Oh, inflation 6%, 5%." And wow, we got 40. Now not a lot of customers were traveling, so they probably don't know that year over year increase. But I'm very curious to see how just general price inflation, or the sense of things getting more expensive, hits the consumer sentiment data that you're seeing, Michelle, that you're seeing, Mike, once the customer checks out. The other piece, Steve, I did a fairly deep dive into quarterly ADR versus CPI, so looking at real ADR growth. And I'm not actually sure that I still agree with that statement that we as an industry are pretty good about it. We were really good through 2016. And after 2016, and we can talk about why, the relationship somehow broke. We were always good about increasing ADR above CPI. But after 2016, 2017, that was not really the case. In 2019, when we had the best year ever, room rate increase was 1%, right? And inflation was 1.2 or 1.3, So I'm a little afraid that we may have broken that relationship. Right now, obviously, yeah, we're just increasing much more, but that's the base effect, right? Because we were so low. But coming back to this question, to Michelle and Mike, if guests are seeing these high rates, Patrick was earlier talking about Colorado, ski areas, and what do they get if they have to wait 35 minutes for a latte, and the restaurants are maybe closed for lunch? What does that do to customer sentiment? Question mark.
Well, I think that's exactly what I was saying earlier, that the tolerance level this year was fine, and the feedback is, and you see it, you don't just see it in the luxury space, you see it all the way down to select service, that the consumer patience is waning. And we see it equally in our Hilton Gardens, like, when is this coming back? When are you going to do this? Something has to give, and we are assuming that we're going to maintain bottom line, especially in the resorts, but that our revenue growth will be consumed by the required staffing that we need to deliver those service levels. And we're hoping there'll be some incremental revenue that can be generated as a result of bringing or having additional staff as well. But that's all aspirational when you can't find the staff, right? That's the tough part right now.
I did an interview recently, and they have a name now which they call skimpflation. Where you're skimping on service and still charging the same prices. And varies on where you are and what's getting cut and how much is getting shaved off. But the notion, of course, is that the consumer's paying for things that used to have a larger bundle of services in it, and are now paying close to the same thing for a smaller bundle of services. Well, a less frequent bundle of services.
I'll tell you what's interesting, and obviously part of the reason is because we were losing so much money. Part of the reason is because we can't get enough staff to provide the services. Yeah. But the brands were really, I think the brands did a very good job of working with owners we didn't have a choice. I said, in the first month, we lost $50 million of cash. When that's going on, you just kind of stop everything. I walked into one of my hotels, and at the very beginning of this crisis, the food service was a bowl on the bar that had some subs in it, submarine sandwiches that they brought in from somewhere. They had no staff. They had nobody to cook or serve. What's interesting is the brands were good about working with us and pulling back all those services. They can see what's happened, what Michelle was referring to about guest satisfaction. And I was in a meeting just a couple weeks ago where a couple of the big brands were talking about this next year is when we bring service back and a lot of those standards, and that's going to cost money. Obviously, we're going to need the staff to do it. And then we've got another issue looming after that. There's like the year that you bring service back, and then there's the year you've got to bring capital investment back. Everyone, we don't talk a lot about this, but everyone rated their FF&E reserves in order to pay debt service. The lenders let them do it. It's the first time I've ever seen that. And, we've come out of downturns before with under-renovated industry. I think there's a good chance that that's worse this time around because everyone used their FF&E reserves for something else, and somehow they've got to be rebuilt over time. There's not enough revenue coming in right now to really rebuild them very quickly. So this is I sound kind of bearish. I'm kind of bullish. This was the golden age of travel before COVID hit, and I think there are a lot of reasons to believe that'll continue, but we've got a lot of repair to do.
Well, first, the expression, I think, is a fully invested bear, But the other side of what you were just describing, Mike, is that when we do come out of that cycle, the costs of a lot of the FF&E that we would have budgeted for 2 years ago, the cost of those materials are going to be way higher than what we had anticipated. So that's going to exacerbate that problem.
Did you just take us to supply chain?
Sure.
One thing I was going to say, Mike, from the Wall Street stock perspective, and there's always, controversy. I hear from public companies that they expect 100 to 300 basis points of permanent margin growth, from various forms of efficiency, whether it's, cutting room service or cutting that extra supervisor in the front desk. But, the question is if companies want to, maintain these high room rates and increase them, eventually the customer is going to want the service, and you're going to have to, maybe you don't have to have room service, but you don't want to wait 20 minutes to check in, and you're going to need that extra front desk employee. So, and not everybody is going to be using the automatic check or the phone check-in. So it's big debate in what I do right now, if in fact they can keep permanently high margins. TBD, take a side and pick your stocks.
And I just want to add some data to that. In 2000, our industry peaked. This was before 9/11, at a GOP margin of 38.8%. And we didn't quite get back there pre-GFC. We got to 37%, and then we peaked again at 38.8%, right on top of 2020 in 2017. So if you look over that period of time and how institutional hotel real estate has become, and all of the operational efficiencies that we've incorporated into the model and all these smart labor models, but yet we haven't, as an industry, grown our GOP margin. And so I too share that question. I want to figure out how to get there, and I just am concerned that all of these modified housekeeping and all these things will be consumed by incremental wage costs, real estate taxes, insurance, brand standard waivers, right? All sorts of those things. And so I'm not bearish. I'm just kind of trying to be realistic. Mike, I don't know how you are looking at it. Because you have to look at it holistically. You can't just look at the resorts that are killing it right now.
Yeah, we're spending, as I know you are, Michelle, we're spending so much time on this right now, working with the brands, beta testing. Are you going to get your room cleaned? What types of hotels are going to be clean and what types are not? We've got a lot of luxury hotels, and I think at the luxury end of the spectrum, I don't think we should be cutting out. I think we have to do daily housekeeping. So, look, right now I don't know where it settles out. You're a pretty analytic person, Michelle. I'm kind of curious if you've got Patrick mentioned 100 to 300 basis points. I don't know where it settles out. Right now, our margins are fabulous. I don't think it's sustainable. I don't think we can work with every one of our properties is short on staff and is trying to hire. I do think we pick up a couple hundred basis points, but that's making an assumption that rates continue to move as all these inputs, food costs and labor costs are growing pretty quickly. I mean, our labor costs, bouncing over to labor here, but we're up. Depending on the property, we might be up 15 to 20% on labor costs this year, way beyond what you read in the newspaper.
I'm always curious about this, and maybe you have insights into that. The people that we lost in 2020, and they're not coming back, where are they? Is the one-word answer to anything we do Amazon, or are they retired? Or, I mean, what do you have any anecdotes about where do the people go, or do they go across the street and this is just, that you're paying them $1 more, a housekeeper or so, and they're bouncing between properties? Where are these people?
Go ahead, Mike.
No.
So I could tell you that the number of new openings of small businesses, people decide to just do their own thing, grew at the highest rate ever. The other thing that we know happened is that there was a lot of people who used some of their support for training dollars. So here at eCornell, we sold tons of things. A lot of people were able to just use that to learn Python or other coding, and are able to find income streams through those mechanisms that are equivalent to the income that they were earning in their old jobs, but without traveling and without the uncertainty of their scheduling, which is a big issue in this industry now.
I imagine we've all had the same discussion where we say, I don't understand. So everyone's got new priorities and don't want to work. And how does that work? How does that math work? I was on a plane not long ago talking to a woman next to me who was the head of HR for a company with about 30,000 employees. And she was saying, I don't get it. I don't know where they've gone. I mean, they've gone to a lot of different places, right? Some people changed their priorities. Some people probably went from got used to going, they went from being a two-wage earner family to a one-wage earner family, and they're going to stay that way. But I sometimes say our industry broke its promise. I mean, I said we furloughed 10,000 people. We assumed they'd kind of be there when we were ready to bring them back. That just wasn't the case. When you stop paying people, they go, some of them go find something else. Some came back. I don't remember the exact number. I think our industry lost about, I know I'm off here, but I think we lost about 6 million employees at the beginning and brought back about 2.5 of that, I think. So we've got a lot of repairing to do in attracting people back to our industry and showing them that they can build a good career here. And I'll tell you, behind the scenes, there are things going on right now. Positions that may not have been bonus positions before that will be now. There's things that will be changing. We've got to change to make this a more attractive industry for people that can go down the street to a different industry.
Does that cut in? Does that cut into the 100 to 300 basis points of permanent margin? That's what we're all trying. At least from the Wall Street perspective.
Well, the good news is labor is what 30% of our cost structure. So I think that's about right. It's not 100% of our revenue.
Percent, Mike.
What's that, Michelle?
I thought it was 60%.
Depends on the
hotel. Sorry. I'm thinking about the revenues.
The benefits.
Yeah, I of course it cuts in, but I do think, I mean, at the moment we're really seeing 15 to 20% labor cost growth in certain markets, certainly in the South, in Florida, in Nashville, and places like that. Has to cut into it.
Yeah, and housekeeping wages in early 2020 were about, $13 before the pandemic, and more recently the national average is, in the high $16 an hour. But to your point, it's more people sitting on the sidelines, and I think people think that COVID created this, and I think this is just another example of COVID accelerating an existing trend. And the trend it's accelerated is, someone said, the younger people are not joining the workforce earlier. They're not, and that delays then their engagement with work. You said the two-family income earners have downsized to one because of all the costs of childcare and what have you. And the interesting thing is the highest engagement is with single parents. So single parents are most engaged in the workforce of all of the different cohorts. And the only group that's growing as a workforce are the 65 to 75-year-olds. So we have to figure out as an industry, how do we engage with those cohorts and to, like you said, give them a career? Or how do we figure out how to execute housekeeping in a way that is not as backbreaking or what have you, that 65 to 75-year-olds can execute that, because that's the growing workforce for us.
Housekeeping is less of a problem when you have a 1.7 night average stay, because you're really talking about not doing your normal rotation for a day, and then picking up garbage or whatever else it is. When you're in these other environments for longer stays, or you have an extended stay property or resort, it gets a lot trickier. So, but Patrick, you wanted to chime in?
I mean, the other thing is just dealing with the customers right now. You're on the tip of the spear, the front lines of dealing with mask mandates and, in some cities, proof of vaccination. I started my career at front desk many years ago, and my God, I can only imagine how, it was never easy to start with. I can only imagine right now, why would you, what's going to incentivize somebody to really want to do that? I guess maybe ultimately it's pay and benefits, and here we are back on the margin front. So it's challenging.
I would say one thing, just so we don't sound like we're too wounded. This is every industry right now. The only person I know who is, I was stunned at how many people he'd hired recently, a young guy who started this crypto company. Some of you probably know him, a friend of ours, son. And he's been able to hire more people than we are. But, someone in one of the, what are they called now? Big Four accounting firms, I think they're down to 4, saying we can't keep 3 to 5 year, he calls them 3 to 5 year kids. We give them 30% raises and someone comes in and gives them 40% on top of it. This is every industry. It's not very understandable. And it feels to me like it's really exploded in the last few months beyond what it was before that. I don't mean to sound alarmist, but it's changed a lot, and we'll see where this all settles out. But it's not just the hotel industry.
Yeah.
At first, it was at the hotel properties. Now it's at the corporate level for each of our companies.
From the Wall Street hiring perspective, definitely the sort of the junior associates. I mean, it's many firms had to raise base wages 15-20% and to keep folks. So, like I say, it's everywhere.
Maybe if I may ask Steve another question that's related. When I talk to reporters, I say I think there are 2 things to be true. Is yes, wages are going to go up, but I think we've also seen some interesting innovation. Patrick mentioned, like we're going to check in with our phone. Not everybody will, I give you that. But I think keyless check-in is like a thing now. It was sort of coming, and Michelle, to your point, it's just really here now. And I'm just curious to see, getting away from just the wage issue, do the 3 of you see other pieces of innovation, Steve, sorry, the 4 of you, that will stay forever? Is there something new and we're like, yes, this will not go back?
I mean,
one of the interesting things, I'm sorry.
Just
yes,
on the food and beverage side, I mean, there's been like little things that add up, right? The ability to use a QR code on a check to pay your bill. So that, right, frees up, a server from, a function that can take 5 minutes and creates a huge dissatisfier for a consumer, right? If they have to wait a long time to get their bill, to pay their bill, whatever. So like there's a lot of little technology. We're really challenging our hotels, especially, where the restaurants lost money before COVID, is why, what's the, like, why not take learnings? I mean, I think Marriott has an affiliation with Uber Eats, or one of them, where they get points, and Hilton, at their Vegas property, they put these coolers, lockers in, like Amazon lockers, and some are warmers and some are freezers. And I think they have a partnership with Grubhub, but why not? I mean, the consumer today wants what they want when they want it. They can get that at home. So why not give it to them? Why would we open restaurants, kitchens, when we know that they're fixed costs, they lose money? Open the bar, we can make money there. There's a lot of innovation opportunities in food and beverage, especially.
Michelle and Mike, I'm curious what you think about sort of room service for some hotels just permanently going away. I know Hilton had sort of started to move in that direction. Do you think that might be a permanent change?
I think I'm gonna pass that one to Michelle. Again, we're primarily, look, if our portfolio's got the highest RevPAR when you comp against any of the public peers, the public REITs. So we're primarily luxury or something pretty close to it. I don't think we're going to be doing away with room service in those hotels.
Yeah.
So Michelle may have a different view in other parts of the sector or the other parts of the industry.
No, I agree with you, Mike. Luxury, we will not get away from it. And I've been impressed how tolerant consumers have been in our luxury hotels, where we just we only offer breakfast. I mean, until September, in a lot of urban markets, luxury urban markets, we would just offer room service breakfast only. The restaurant wasn't even open, and our rates were still up, but the consumer expects room service. Mm-hmm. And the tier below, to your point, the markets were long on their way to solving for the room service. So
now, I guess what has changed, I remember early in my career when you'd settle into a nice hotel and what am I going to have for dinner tonight? This is going to be fun. Now it's not so fun. I mean, there's a couple salads and you can pick your protein. It's a little simpler offering.
And I think, Mike, you probably would agree. It depends if you're in a unionized environment versus not. It's much harder to have any, or maybe I'll put it differently. It's much easier to consider exploring alternatives when even a $30 hamburger, you're losing money. So that's part of that.
Of course.
I'm happy to continue to talk about these issues, but I did also want to spend a little bit of time talking about, what's going on in the transaction market, valuations. That's obviously going to be I'm not even going to say a tale of two cities. It's a tale of many cities. So I don't know if anybody wants to chime in a little bit about what we're seeing in the transaction side, the price, the valuations, the massive increase in interest and capital in the market. So
maybe if I may just set the stage. So the CoStar obviously tracks this information, so through December 15th, we've had $45 billion in hospitality real estate transactions. That compares to 15 billion last year, which compares to 40 billion in 2019. So very, very active. And then obviously there are these blockbuster numbers that come out of California, the Ventana Big Sur for $3 million a room, or just under $3 million a room from Giolo to Hyatt, which then counted to 5 and flipped it immediately over to Host, for $3 million a room. Montage, Healdsburg at $2 million. So high-end resorts are just, on fire, a lot of interest. And let's not forget, Cosmopolitan, according to Blackstone, highest profit for a single asset of around $4 billion when they sold it basically to themselves. The PE fund sold to the REIT. So lots of interest on the very high end.
Yeah, especially we see that in public markets on the resort locations. Huge transactions single transactions by Host, by Sunstone. But below that, it seems a little bit more lately, sort of net sellers, getting New York, you go back 10 years ago, was the market everybody wanted to be in. And now everybody can't wait to get out of New York. And you go back 3 years ago, it was San Francisco. And, I don't think we've seen too many sales, but, that'll be interesting to see what, how long companies want to hold on to hotels in San Francisco with negative cash flow, which might last, a couple of years here. One thing, I met with many of the public companies last week at my virtual conference, and there's some chatter about possibly private equity getting in, because we definitely see it, a sizable discount where the stocks are trading versus net asset value, and there's some chatter that private equity might make a bid. One of the things that's always been interesting on the public markets, there's always been significant resistance from management teams to actually want to sell for various reasons. So, I think it'll be interesting to see, especially as the public stocks, continue to pull back here. Do we get in? Do we get a Blackstone bid here? And if there is, does management fight it tooth and nail, or do they take the money? So that's That's the latest debate right now.
So I guess I would add, agree totally on the resorts. What's kind of interesting is when you look at where you can get yield in the real estate industry today, you can't get it in multifamily. You can't get it in industrial. I mean, those yields have been pushed down very low. So we had this theory that you were going to see a lot of demand for select service. We just closed on a transaction yesterday, selling the bulk of the select service that we've got remaining in our portfolio. I think we'll continue to see demand for that kind of asset. We haven't seen a lot in urban markets yet, big box urban markets. Not a lot. No one's been that constructive, I guess, yet on narrowing the bid-ask spread in the cities. So, that will come. We're just not there yet. What hasn't been talked about yet is on the debt side. The debt markets have gotten so much stronger than they were going back a year. I mean, costs of capital have compressed. Today they're 3 to 4%, depending on how much you're borrowing and the asset type. When we did a couple financings right after COVID, and back then it was probably, closer to 6 to 8% for a moment, and then it started dropping very, very quickly. But there again is a tale of two cities. If they're assets that have cash flow or a path to cash flow, or one that looks like a very long haul. So debt markets are good. I think the transaction markets are good, but it's going to take time for urban hotels.
And I'll just add, when we're underwriting in these urban markets that, quite frankly, there isn't a lot of visibility on the recovery. It's still a bit of a guess because of these fits and starts. We almost have to underwrite making an assumption of kind of the recovery as kind of aligned with the prognosticators. And then we look at it and say, okay, let's just say it pushes out a year. What does that do to the deal, IRR, and PB? And sometimes it's highly sensitive, and sometimes it's not as sensitive as you think. And that really informs, right, whether you really want to lean into the pricing or not. And I think that lack of visibility is still, and the assumptions around carry cost, duration, because even though hotels might be close to EBITDA, or most of them are EBITDA positive, you still have debt service and capital reinvestment. So I think those are the challenges in the recovery of the urban market pricing at this point. When there becomes more consistency and momentum, we'll see the urban market pricing move quite quickly.
But do you see, and I think I mentioned this earlier, and people are talking about this in the residential side, do you see the increasing likelihood of interest rate rises, at all compressing value or not?
Isn't it still going to be cheap? I mean, even if it goes up, it's still really cheap.
And even if the Fed does three increases next year. I mean, we've got so many debt funds out there today that are fighting for this product to make these debt investments. I'm not sure that translates to you might see margins. You might see interest rates rise, but the lender margin decreasing. So I don't think they move a lot.
Okay.
Unless this is runaway inflation and we don't understand it yet. That could be a different discussion.
No, I think it's going to manage, to your point.
So we have one question that I don't know if anyone here has some insight into, and that has to do with hotel unions, unionization. Obviously the big cities, they're already in that environment. Do you see that expanding? What's going on with, obviously Starbucks in Buffalo may not be an indication of anything, but do you see unions? And unions have had a real strong hand in some of these markets in terms of work rules and so on. Are we going to see more of a partnership with unions? Are we going to see more activity? in terms of unionization among properties and cities? Do you think of any of those things?
So
Sure.
I would say that more new developments will likely be union. There have been a lot of ordinances approved. New York City is a good example. So if you want to develop a hotel in Boston, you need to sign a neutrality agreement. That's just the way it is. So I think there's more of that. So we'll see more union hotels from a new development standpoint. So from an existing stock standpoint, it's it all depends. It all depends on how the associates are treated and their compensation. Right, those are big variables as to why typically associates reach out for help if they don't feel like they're being treated equitably.
I would say, and Jan, you might want to have thoughts on this as well, from an overall U.S. perspective, and I'm looking, more outside of urban areas, because the growth in the overall industry has been sort of your mid-scale, lower mid-scale, like True by Hilton or Home2 Suites, that just in general as a percentage of growth, probably less unionized going forward. Just with those hotels not being unionized, and I think that's been part of one of the reasons why growth in that sector has been very, very popular, because you don't have to really worry about a union if you're building a true hotel. Jan, I wonder if you have thoughts when you look at the Smith Travel pipeline.
Yeah, I mean, so in the peak was 212,000 rooms in March of 2020. 73% of that is limited service. We're just not building these super tankers. We don't build a whole lot of them. Like we build one here, one there, but they're just really expensive to do. And if you have $100 million to spend on development, would you rather build 6 courtyards or 1 Ritz? It turns out you prefer the limited service box. Which is certainly good for people like Mike, because there's not a lot of competition coming. But it's very, very clear that that the developers are voting with their wallet and going limited service. And then I don't know enough about the union question, but I think, Patrick, what you're saying sort of rings true. If you only have 10 people on property, that's probably not that interesting for you night here.
So we only have a couple of minutes left. I guess if you were just, I'll just go around the clock here and say, if you were looking, would you be highly optimistic for the coming year, somewhat optimistic? Where do you place yourself? And let's just start with Jan, so I'll just move around my screen.
So we can't be pessimistic. We just can be either like super bullish or bullish.
I think there's been a lot of pessimism. So just a quick one, yeah.
No, I think moderately optimistic, right? STR is proposing that we're going to hit room demand and room rates, not inflation adjusted, for 2019 levels in 2023. So we're firmly on our way to recovery. Omicron is a hiccup. Groups, as we've heard, are still strong, and the leisure customer is going to save the day for a lot of properties and for the industry overall.
Awesome. Michelle?
I think I mentioned earlier, we're slightly behind STAR in the view of the recovery in 2022, but if rates hold up, there's no reason we can't be back to 2019 levels in 2023.
Awesome. Mike?
So, look, I think this is maybe the first time in my career that we know the industry is going up. We know next year is not going to be worse than this year. A lot of the data that I've been looking at in our portfolio over the last number of weeks actually gives me a lot of hope. I think consumers have a lot of cash in the bank. They are starved for travel and experiences. And I think we are going to surprise on the upside, maybe by a lot. We might really surprise ourselves. These variants keep pushing it back and pushing it back. Hopefully we move past that. But I'd say I'm quite optimistic.
Awesome. Patrick?
Yeah, I would say I'm mixed, and it really depends. I'm very bullish on the domestic leisure side, and that's certainly reflected in the stocks that I have buy ratings on, a bit more such as Wyndham Hotels or the vacation ownership companies. Unfortunately, I think for probably the next month or two, I'm pretty pessimistic on things like business travel or large corporate meetings. I think there's in the last day or so I've seen some pretty disturbing reports coming out of UK with Omicron and just pullback in restaurant visitation. So I'm in the near term I'm pretty bearish for that, but long term domestic leisure super positive.
Awesome. Well, thanks everybody for your time. This has been a great discussion. Each of you, I want to say thank you for spending some time with us today. And for the audience, I hope you appreciated the opportunity to be here with our panelists. So thanks, guys. Thanks.
Good to be with you all.
Happy New Year.
Thank you.
Holiday.
Thank you.
Happy holidays. Bye-bye.